Well, good afternoon, everybody. Thanks for joining me. Today, we are talking about year-end tax planning. And so we're going to be going over things like, should you be making a pre-tax or a Roth contribution to your retirement accounts? What about the timing of your property tax payments? For tax deductions this year, can you get any more tax deductions, or should you be deferring your deductions into next year and maybe even accelerating income into this year? We're also talking about some charitable giving strategies as well. So good time to tackle all of these various items. So welcome. Let's get started. And so it helps to have a good basic understanding of the how the tax code works before we jump into the strategies. So everybody gets at least a standard deduction, and then we start paying taxes on any income above that. So for a married couple, $25,900 this year is the standard deduction for MFJ, married filing jointly. If you are a single individual, it's just under $13,000. So in other words, you do not pay taxes on the first $26,000 or $13,000 of income that you have. Now, any income above that amount, we do start to pay some taxes. And so the federal tax brackets are listed on the top left side of the page here. They start at 10%, then they go up to 12, 22, and so forth on the way up. And the way that it works, think about filling up various glasses full of water. So the first glass, you can fill up with $20,550 in it. And once that glass is full, then we start filling up glass number two. So anything above 20,550 up to 83,550 and so forth on the way up. And so as you get to that last glass that you're filling up, let's say that it's in the 24% tax bracket here. And one thing I could do is, well, if I don't want to pay 24% in taxes this year, well, I can take the money in that bracket and actually defer it. I can defer it by doing really typically two things: making a pre-tax contribution to my 401k or 403b, or making a contribution to a health savings account if you're eligible for that. You'd be eligible if you have a high deductible health insurance plan. So not everybody can utilize a health savings account. But that's a way to take that money that's in that last glass and defer the taxes on that to a future year when I can perhaps fill up some glasses at the lower tax rates. And so one of the common misconceptions here is that, well, what happens if I go $1, into the next tax bracket? Is all of my income taxed at that higher tax rate? And the answer is no. It's only that last dollar in that last glass that is taxed at the higher rate. Remember, all those glasses getting up to that point, they're all the money in those glasses is taxed at 10, 12, 22, and so forth on the way up. So it's only those last dollars that are taxed at that higher rate. And so that deferral into a 401k, 403b, or an HSA, that's one way to reduce your taxes now. There's a couple of other ways to reduce taxes, and that's through tax deductions as well as tax credits. And so let's take a look at Schedule A of the tax return. That's where all of the tax deductions show up. And there's really 4 different categories that are more typical for most people of what is deductible. And so those categories are on the left side of the Schedule A. So medical and dental expenses. For folks that are working, typically I don't see anything in this category. Taxes that you paid, oftentimes there's a lot of money here, but you notice we've also got a maximum of $10,000 over in the numeric column on the right side here. And that's because of the Tax Cut and Jobs Act that was passed a number of years ago. It actually put a cap on the state and local taxes. So SALT, state and local taxes, that's your Wisconsin income taxes and your property taxes. The maximum that you can deduct is $10,000. Going down the list, interest that you paid, typically this is mortgage interest for most people if you do have a home loan. And then the final category that many people may have deductions are some gifts to charity. And if the total of all of those itemized deductions exceed the standard deduction of $26,000 or $25,900 or just under $13,000 for an individual, then you get the benefit of itemizing and taking an additional tax deduction, but really it's for the amount that exceeds your standard deduction. And so that's a kind of a quick preview of how those deductions work. So for most people, really the only deduction that they do have some control over are those charitable gifts. And so let's talk through the charitable giving strategies here and see if we can maximize that a little bit more. So we're going to go from simplest to most complicated and most tax efficient for charitable giving. So first is just simply making a cash gift, dollar for dollar cash gifts. The next would be giving appreciated investments. And so the advantage here is that any of those capital gains, those unrealized capital gains that you have not paid taxes on, if you give those shares to charity, a 501c3 organization doesn't pay any income taxes. They can sell those shares and realize the full value of those gifts. So it's a little bit more tax efficient way to make a gift over just a cash gift. For anybody over age 70 and a half, there's a special rule called a qualified charitable distribution, or QCD. And this is actually a transfer from an IRA directly to charity. Now, normally, anytime money comes out of an IRA, it is taxable income to that individual. However, if the money transfers from the IRA directly to charity, that income does not show up on the tax return, even if you do not itemize your deductions. And so that's a very efficient way to make a charitable gift, but you do have to be over age 70 and a half and have an IRA in order to do that. For those of us that aren't over age 70 and a half, you might be able to bunch together a couple of years of taxes, in 1 year. So here at the end of 2022, maybe you make your 2022 charitable gifts as well as your 2023 charitable gifts, but do those in 2022, so that might give you enough to itemize this year versus claiming the standard deduction for this year and a standard deduction next year if you wouldn't otherwise be able to itemize. And we can actually take that bunching strategy one step further, and instead of just bunching 2 years of charitable gifts together, let's bunch multiple years of charitable gifts together. The way to do that is through what's called a donor advised fund. And so it's basically a charitable account. So any money that you add to the charitable account, or even better, appreciated investments that you add to that charitable account, that triggers a tax deduction for this year. So you could take what you're planning on giving for the next few years, let's say through 2025, because the tax rules change again in 2026. So maybe you take the gifts through 2025, put them all into a charitable account, into a donor advised fund this year, claim the tax deduction for this year, that itemized deduction, and then use that charitable account to make your charitable gifts for 22, 23, 24, and 25. And in many cases, I see that this actually provides a much better, a much larger tax deduction than simply trying to claim those charitable gifts year by year. So that's how the deductions work. You might also qualify for some tax credits. These are a little bit more hit or miss depending on your personal circumstances. So for example, if you have kids that are in college, there is something called the American Opportunity Tax Credit. That's a college tax credit. If you have kids living at home, there's the dependent tax credit, the child tax credit. So you may or may not qualify for some of those tax credits as well. So let's kind of extend this strategy here and talk more about lifetime taxes. And what's very, very common, especially among physicians, is something that looks like this. And so this is an actual client case. They are in their early 60s and planning on retiring at age 65. And so the blue on this graph represents their taxable income. So about $400,000 today. Once they retire, the wages stop, and so their taxable income drops substantially. You see in their mid to late 60s, they're picking up some taxable income due to Social Security and some other sources. but it also picks up again at age 72. And what happens at that point is you have a required minimum distribution. So the IRS forces you to take money out of those tax deferred accounts because they want to collect their taxes on it. So the amount that has to be withdrawn from those accounts is based on a formula. And so the uniform lifetime tail is that formula for RMDs, required minimum distributions. Basically, the way it works, if I'm 72 years old this year and I have to take my required minimum distribution, what I do is look at the retirement balance from last year and then divide it by this factor. So in this case, 27.4. It's roughly 3.5% that first year. And that factor does change year by year. And so, if I'm 80 years old, it's not really right around 3.5% anymore. Now it's about 5% that I have to take out. So those RMDs, those distributions from those retirement accounts, tend to get a little bit larger over time as you go through retirement. And in fact, that's what we see, on this graph as well, is that blue continues to increase over time. The horizontal lines going across this blue graph, those represent the various tax brackets. And so one way to minimize lifetime taxes, let's say that this couple was age 65 this year, and they may actually not be looking for tax deductions like they were when they had $400,000 of taxable income, but at age 65, age 66, they may actually accelerate their income and pay some taxes, but they're doing so at those lower tax rates rather than deferring income to later and paying taxes at those higher rates. And so it's a matter of filling up those various brackets. Now, we're going to talk about some of these other brackets here in a moment, but this is a perfect example of that, where the green on this graph represents accelerating income, in this case, doing Roth conversions, taking money from their IRA, transferring it or converting it to their Roth IRA. Any dollars that they convert shows up on their tax return for the year as taxable income, but then they never have to pay taxes on it again because it's inside of a tax-free Roth IRA. So in this case, it's worth $133,000 of lifetime tax savings by actually accelerating some of their taxable income into this year. Now, there's a couple of other brackets that I have on here as well, capital gains and Medicare. Let's talk about capital gains first, and do so through this lens of, at age 65, in this first graph, it looks like this couple has zero income, and really that's not the case. So there's a difference between cash flow and taxable income. So let's go back to our tax brackets here for a moment. So let's assume that this client has $200,000 investment, not inside of a retirement account, and that's the only thing that they are going to live on for this year. They're delaying Social Security. They're not taking any distributions from their tax deferred retirement accounts. They just say, hey, this first year retirement, I got this $200,000 investment. I'm going to cash that in. Well, that investment not being in a retirement account, they've already paid some tax on it. So let's pretend my mug here is filled with ice water, right? And so they've already paid taxes on that ice. So after tax ice, they only have to pay taxes on the water portion of it. So $200,000 of ice and water in here. Let's say half of it is ice, the other half is water. Well, with that water, we're going to fill up our tax brackets again. So married couple, the first $26,000 non-taxable because they at least get that standard deduction. But in this case, it's capital gains, not ordinary income. And the capital gain rates can be much lower. So, so if roughly half of that $200,000 investment was ICE and they need to pay taxes on about $100,000 of it, well, we already saw about the first $26,000 is not taxable because of the standard deduction. And then we also have the first $83,000 of capital gains is taxed at a 0% tax rate. And so anything times zero is zero tax. And so here's a situation where they could actually have $200,000 of cash flow coming in for selling this investment, but their tax is actually zero for that year. And so it's very possible to have that situation. Also on the bottom of this page, notice the Medicare premiums. And this is another gotcha that can sometimes happen as people are doing some tax planning in retirement. So generally speaking, the more income that you have in retirement, the more Medicare premiums that you might be paying. And these are cliff vesting schedules here. And so Medicare works off of something called MAGI, Modified Adjusted Gross Income. And so you see these various brackets here. So if your modified adjusted gross income and your merit is less than $182,000, you just simply pay the $170 monthly premium per person. But as your income goes up to these various levels, you start to add on additional income for Medicare Part B, as well as for Medicare Part D, the drug plan. And that's per month per person. And this is also cliff vesting, meaning that if you do go $1 into some of these higher brackets, your Medicare premium does jump by the full amount. So that one going over by $1 can really hurt here because you're paying higher Part B, higher Part D premiums per person per month. So it can be thousands of dollars that crossing that threshold by can cost you in Medicare premiums. So we do want to keep that threshold in mind as you're thinking about how much income to accelerate into a year. Now let's go back to the deductions for a moment here. One thing I failed to mention was the timing of property tax payments. So let's go over that quickly. You know, for most people, paying your property taxes doesn't help you out on your federal tax return. However, in Wisconsin, it can still help you out on your state income tax return. So what often makes sense is to pay $2,500 of property taxes in a calendar year, and that'll get you the maximum tax credit on your Wisconsin taxes. Now, thinking backwards of 2021 property taxes, if you delayed those and you paid them in, let's say, January of this year, you may have already reached that $2,500. And so when the bill comes in the next couple of weeks, you could potentially just postpone the upcoming property tax payment into 2023 when it's due. And so lastly, let's take a look forward at 2023, because most people have an option of either making pre-tax contributions to their 401k or 403b or Roth contributions to that same account. And so, here's a good general rule of thumb of how to decide what you do, either pre-tax or Roth. So what we're looking at are the 2023 tax brackets. And if your income puts you in some of these lower tax rates, 10, 12, 22% many times, it often makes sense, especially 10 or 12%, to pay the taxes now and make Roth contributions. And then that grows tax-free and the IRS can't tax that ever again. If your income next year is going to push you up into the higher tax brackets, especially 32% or higher, it probably makes more sense to make pre-tax contributions and get that tax deduction. And if you're right in the middle in this 22 and 24% bracket, that's a little bit of the gray area where it may end up being a wash, whether you do pre-tax contributions or Roth contributions to your retirement plan at work. But that's a good way to, at least a good rule of thumb on how to manage those 401k or 403b contributions. And so with that, I want to leave a couple of minutes for questions. So if you do have any, I'll be happy to answer those at this time. Otherwise, wish you well, and thanks for joining me today. Have a great one. Bye-bye.